Hey folks, Dan Friel here with your opening bell for July 3rd, 2025. So what we were waiting for is the jobs report. Well, we were waiting for a few pieces of the puzzle to drop today or in the next couple of days. We were waiting for the jobs report that we just got. I'll take it to CNBC here in a second. But then we're going to talk about the big, beautiful tax bill. Hit some speed bumps last night. And then the tariff relief. How's tariffs coming? We're going to get to all that in 1 second because I want to take you over to breaking news. The 10-year Treasury leaps. Oh boy, after jobs figures are much better than anticipated. What's the jobs report look like? How's it going to affect the markets? Let's get over to CNBC and check it out.
Rick Santelli is at the CME in Chicago. I don't know what you think about July possibly being a live meeting based on these numbers, but sub 50 in terms of additions seems to be the number that could make it live.
So what she's talking about is people keep saying the unemployment's going to spike, and it's going to spike big. The unemployment rate's going to go up. Everybody's going to lose their jobs. This data doesn't look like it's going to happen. But she mentioned what would happen if we hit a 50,000 jobs report. Well, let's see what Rick has to say about it.
The markets.
Anything's possible. We'll know shortly. Obviously, it's the big June jobs report. I wouldn't look for this to make an easy more likely. 147,000 jobs. Definitely a bit better than expected, no matter what your range was, whether it was closer to 100 or 115,000. It's a pretty good number. And guess what? If we look at the 2-month revision, it's positive. It's up 16,000. How does 147 stack up? Well, it's pretty odd because it's exactly where we were in April, unless they revise that. To find a higher number than that, well, you're going back to last year. So this is tied for the, second best, tied for the first best number of job creation of the year. Now, let's look at the numbers for unemployment rate. That number is coming in at, it's coming in at... Where is it to underemployment? There it is, 4.1%. Sorry, folks, we do this on the fly. 4.1%, and obviously 4.1 equals where we were in February to find a lower unemployment rate at the beginning of the year when it was at 4%. Now, if we look at average hourly earnings, up 0.2, we're looking for up 0.3, and the rearview mirror is up 0.4. Up 0.2 equals where we were in April. To find a lower number, you really have to go back in the Wayback Machine. You're going all the way back to August of 23 when it was up 1/10. So earnings are something to pay attention to. And you see the same dynamic when you look at year over year average hourly earnings. 3.9 rearview mirror, 3.8 expected. Boy, 3.7. How does that stack up? That would be the lowest yearly rate going back to July of just last year when it was 3.6. Now, if we look at the average weekly hours worked, 34.2, that equals where we were in February. We started out the year at 34.1. The underemployment rate. So U3 is the actual unemployment rate that we pointed out. The U6 is the underemployment rate. We like to pay attention to that. Obviously, it's been coming down rather dramatically. That now stands at 7.7%. That follows 7.8%. And that would be the number that we're very close to expectations. Finally, labor force participation, always important. We want to bring back people in the workforce. And this time we did not. 62.3. We lost a tenth. 62.3. And what's very fascinating about this is these numbers have been pretty steady. 62.3 equals DECE of 22. 62.1, you're in NOVA of 22. Listen, it doesn't end there. This is Thursday. Initial jobless claims coming out at 233,000. That is a drop of 4,000 to a slightly revised 237,000. Still keeps that pretty darn good. Well, just like JOLTS, not a bad number for the labor market. ADP seems to be an outlier at this point. And finally, continuing claims coming at 1,964,000. That means it's 6 consecutive readings over 1.9, basically comping to 2021. And the trade balance for May, which is obviously a deficit at minus 71.5 billion. And the rearview mirror, 60.3 billion. Boy, has that come down with all the trade issues. Just think, March was 138 billion, by far the biggest deficit since record keeping in 92. Now, after all that, what happened? Well, all you needed to see was that 147,000 in positive 2-month revision. Yield shot up like a bit of a rocket ship. 435 in a 10, we settled at 428. In a two-year, 380, that's up 11 on the day. And both of those metrics were down 2 basis points before the number. Pre-opening Dow futures more than doubled from up a little less than 50 to now up 115. It should be no surprise that these are good numbers. And, Melissa Lee, you were asking, would I think that this is going to make a big difference, put July hot? I think what this does is make everyone question the dynamics of what issues are going on in the economy that would need an ease. I understand the president's view. I understand Jay Powell's view. But in the end, it certainly seems as though it's just about right now, considering what's going on with the risk on, risk off in the equity trade. Back to you.
So that was a lot of information. So let's get over to it. Basically, here's the basics of this. The jobs numbers came in better than expected. A lot of revisions came in better than expected. It dropped the unemployment rate. Look, the unemployment rate was 4.2. They thought it would go up to 4.3. It actually dropped to 4.1. I'd like to know who's in charge with all this stuff. So here's what the numbers look like. Non-farm payroll, 139,000. Was the previous is expected to be 110. It went to 147. Average hourly earnings and everything else. Everything else is coming in kind of right on point. So this is going to drive the government mad, or President Trump mad, and then also puts the Federal Reserve in a pickle, because now it's like, okay, you got an economy that's kind of clicking along, but you have all these uncertainties. Well, let's get over and recap what we're going to focus in on today, and let's take this data and extrapolate it and see how it's going to affect the markets. So my name is Dan Friel. I actually do this report twice a day to inform you guys what's going on with these things over here. The reason why I do it is, folks, I'm a federally licensed mortgage loan officer. What that means is I'm licensed in all 50 states as well as Puerto Rico, because I work at a federal bank. Okay, so I do have a slogan: one application, one credit pool. We're going to shop your loan over 30 different lenders. How do we do that? I'll give you all that at the end of this video, folks. You're here for these things, so let's get to it. So mortgage rates, they ticked up a little bit yesterday. That tick's going to continue today based on this news. U.S. Treasury yields leap. So when you see Treasury yields leap, you pretty much know that mortgage rates are going to jump as well. We go over to the markets right here. The bond market, here's how it's reacting. The MBS is down 15 ticks. So mortgage rates will tick up a little bit more today. We might be at 6.75. Nothing really to be, write home about. So that's what we're seeing the right there. Here's basically what we got over the last couple of days when it comes to the economy. ADP, we're going to just start scrapping this data like he just said, because the data they come in with is actually weaker than what was expected. Well, the numbers actually came in better than expected. Okay, so here's what came in yesterday. ADP said the jobs markets are just starting to plunge. They expected about 100,000 new jobs created. It was negative 33 by their by their data. When you go over to the true data, we're going to see here average hourly earnings 0.2, less than expected. So, people aren't getting the money they're needing. Initial jobless claims basically stayed right on point, a little bit lower than expected. We have a non-farm payroll, 144 previously. They thought it'd go down to 111. It went over the last reading at 147, and this one was revised up. Then we just got the unemployment rate dropping. Okay, so let's get over to all the stuff that the Federal Reserve looks at. This hasn't been updated. Let's see if they update this yet. Let's see, where is it? Where'd it go? Okay, so they didn't update this yet, but here's what the Federal Reserve controls. I go over that every day. If you want to check out that, just check out some of my other videos. Inflation, the inflation numbers that the Federal Reserve monitors is called the PCE. We got this it was last week or the week before. It ticked up it went from 2.1 to 2.2 to 2.3. So it's ticking up a little bit. This isn't what's really scaring the Fed and the markets. It's right through here. They're hoping the jobs market just doesn't crumble. Well, based on today's news, I won't say this is a fantastic number, but it's a little bit better than what was expected. So good numbers are 150, 200,000 a month being gained. So this is going to drive down the unemployment rate, and then the GDP will get more GDP figures kind of down the road. Is the Federal Reserve going to change their vote because of this? Well, let's see what they're going to do. In 27 days, the Federal Reserve is going to meet. So what we focus in on is the CME FedWatch tool. They actually created this to give you insights on possibly what the Fed's going to do. So in 27 days, the Fed's going to meet, and what are they going to do? If you go down through here, we're going to look at the probabilities. Right now, like I said, the federal funds rate is right at 4.25 to 4.5. Well, now the July cuts are, we'll just say they're off the table at this point, because there's a 95% chance now Federal Reserve's not going to cut because they're going to keep rates the same. But at the next meeting, now they're saying almost a 75% chance the Federal Reserve will cut at the next meeting. So we'll focus in on this at coming videos that we go up until the point. But you guys hopefully you learned a lesson. Last September, the Federal Reserve cut rates 0.5%, one of the biggest cuts in decades. Mortgage rates spiked. So mortgage basically rates are factored by bonds. They take all this data in consideration, but the news so far today isn't so bad. So you might see, look at these moves in Wall Street. This is what happened at the opening bell when the jobs number was announced. They're like, okay, rate cuts are off the table, and it just plummeted. But we do have limited trading today. So what that means, we never hear that markets are closing early and there's a holiday weekend like today. We have a holiday weekend tomorrow, so a lot of people are probably going to take vacations. You might as well. So the view count on this video might be terrible, but there's a lesson to be learned. What happens on Wall Street is they do the same thing as you and I do. They'll take maybe a half a day today and tomorrow off and so forth. So a lot of trading is going to be kind of exponentially or multiplied, put it that way, because of limited trading. And this happens all the time on holidays that fall on Friday and so forth. So when you see the market open like this, it's a knee-jerk reaction, not a lot of traders, and then you might start seeing this trickle back up. So we'll focus in on this. I will be back at the closing bell just a little bit after noon today to let you know how all this closed, plus some a little bit more information from you. But that's what's going on right through here. I am shocked if we go over to the, let's see what CNBC is doing with the equity markets. This is kind of odd, I guess I'll say. The Dow Jones and basically all the way across the board, equities are up. The VIX is down about 3%. So that's good news for the markets and the anxiety on Wall Street. But I thought possibly if we got a bad jobs report, that equities would kind of take it on a chin now. But what we do have is some more data coming in. I think down through here, the House is going to vote on the big, beautiful tax bill. I was watching that last night, and it looks like they didn't have the votes, but they probably are going to get those today. The jobs numbers are looking good. Inflation is really not ticking up that much. So overall, when you look at the economy, you look at inflation, kind of in check. They want this at 2. It was at 7. Now it's down to 2.3. We have an employment rate to just tick down. So overall, the economy doesn't look so bad. So just think of it this way. Just give me a chance here. Just think if tariffs aren't as bad, they're not as cataclysmic as everybody thinks, and we get some good tariff deals. The big, beautiful tax bill doesn't add $50 billion or $100 billion or $1 trillion to the deficit. Just think if all this does settle down and the markets just settle down. Just ponder that. If you look at the economy in general, it doesn't look so bad. Inflation's not so bad. The unemployment rate's pretty darn good. Wages are looking good. And so if you look at it on the Fed's view, it's like the economy's not too bad, but they need to cut to bring down a lot of the interest payments on the national debt, as well as the debt that you and I hold as well. So the recap for the day is mortgage rates, they'll probably pop up a little bit. You might see that hit 6.75 by the end of the day, and I'll let you know that. Stock market's looking pretty darn good across the board. We have the indices up all the way across the board, the VIX down. See what oil's doing. Oil is down. This was moving up quite a bit yesterday. Oil retreats as U.S. tariff uncertainties and OPEC supplies. So here we still have the tariff deals here, but oil is coming down right in check. And let's go over to cryptocurrency. It is 110. This might be a record high. I know 110-ish was a record high. So I'll give you all these updates at the end of the day there. So we got mortgage bonds down 16 ticks, making a little bit of a comeback right through there. The economic calendar, we got the news for today, the whole chunk of that, and it looks pretty darn good if you're an optimist saying, okay, I like this data. If you're also a pessimist and you're going through here saying, well, I don't like this data because I wanted more people to lose their jobs and everything else, folks, you didn't get your wish today. So that's what we're seeing so far in the markets. And it looks like the Federal Reserve, it will not be cutting at the next meeting that's coming up in July. This data can change on a dime, and it can change on a tweet. So pay attention to my channel. All I ask you to do is stop in in the mornings, in the evenings, for about 5 minutes, you'll get all the news that you need when it comes to real estate, stocks, bonds, and cryptocurrency. So my name is Dan Friel. I do this report twice a day. Let me tell you a little bit about myself. And if you want to learn more about me, just go to therateupdate.com. Here's our website. So I'm actually a mortgage loan officer, and I work at a federal bank. That means no matter where in the country you live, I'd be able to help you. So the unique thing about us is we have a slogan. It's one application, one credit pool. We're going to shop your loan over 30 different lenders. Now, here's how we do this. We're set up with, we're like a broker, I guess. We're set up with 32 other lenders as well as ourselves. So I can do your loan here, but if another lender has maybe a better rate, the exact program you're looking for, or maybe even this program down here, $7,000, up to $7,000 if you're looking to buy a home. You can check that out. This is one of the investors we just picked up. So if you want to learn more about this and how to buy a house or maybe even how to refinance, please visit my channel. I'd love to help you out in any ways. If you want to reach out to me personally, you can give us a call, 844-775-5626. You can ask me a question right over through here. We did add 2 pieces of this puzzle. So if you're looking to refinance, I'll get to that in 1 second. But if you're locked in and you want me to compare your rate or your terms to up to 33 other lenders, just upload your loan estimate right here. It's because loan estimate review. A lot of people are not finding this, but it's right along the top bar. You're going to click that. All I want you to do is give me your contact information, upload your loan estimate in here. I'll review it and get right back with you with a video to let you know from the 33 lenders we have, can we get you a lower rate? Can we get you lower fees? Can we do both? That's what we're hoping to do. So that's what you could do there if you're looking to refinance and just pick that sweet spot, exactly what rate you want to get notified if your rate gets to that. So let me explain to you. If you're a homeowner now, and you're like, I'm at 7.5, and when this gets to 6.5, I want to refinance. Well, don't miss it this time. Just go to our refinance tab, go down through here. You're going to put in your current mortgage information and what rate you want to refinance. When that rate hits that, I'll be reaching you. We'll be locking you in, getting the paperwork started, and making sure we're getting you on your way to savings. So that's our report for this morning, folks. But mortgage rates, they will tick up just a little bit on some great news on the unemployment numbers or the unemployment rate. So thanks for watching. God bless. Have a fantastic afternoon. Stay safe out there, folks, and I'll be back around 1 o'clock today with the closing bell. See you then. Bye-bye.